We've all been watching the stock market take a little tumble, I guess you could call it, and we all want to know why. Of course, there's never just one reason, but I am going to give you a little bit of insight into why stock prices are falling and what you can reasonably expect in the future. Hi, I'm Teri, and you're watching the Modest Economist channel. One of the reasons that stock prices are falling has to do with higher interest rates and inflation. There isn't a direct link, as I mentioned in a previous video. Of course, there never is. Everything is sort of implied. But the implication for the stock market and for many companies is that with higher interest rates, it's much harder to borrow money. And so if you think about a company or corporation, they can issue stock. They can also issue debt or bonds if they need to borrow money. The problem is that when interest rates go up, a corporation's ability to borrow money becomes a bigger expense. So higher expenses will eventually eat into corporate profits. And that's one reason that investors are a little bit worried. In addition to that, in addition to higher interest rates, we have inflation. And inflation shows up in many forms. You don't know with each individual company exactly how inflation is impacting their supply and demand. There's only so much that you can pass on to the consumer before the consumer looks for alternatives. And so you kind of have a double whammy. You have the Fed raising rates and you have inflation. So investors are seeing that, at least in the short term or until the inflation and higher interest rates issues are resolved, that companies may not be as valuable and their share prices drop. It's not really fair because there are plenty of companies that are doing very, very well and are just kind of tossed into the mix with every other company that might be in their sector and not performing well. And that's what makes this an interesting time and probably a good opportunity to start looking at companies to invest in, companies that have been around for a long time, companies that have a track record, companies that maybe don't have to borrow or don't have so much debt. There are, of course, a lot of other reasons that the price of a stock can go down. All I've really done is given you a bigger picture of how higher interest rates and inflation can impact the price of a stock. If you want to know when this is all going to end or stop, what's come up in the news recently are talks of a recession. That wouldn't be unusual. It certainly wouldn't be unheard of. But what happens when we get to that recessionary point, it means that the economy has started to slow. And so corporate profits may not be as robust as we might expect. But the other thing to remember is that this all takes time. Things don't just all happen at once, overnight. And we are in a period right now where growth has already started to slow, although inflation remains high. There's another name for that, which has been thrown about a little bit, and that's called stagflation, when you have low growth, low unemployment, but high inflation. And remember, the Fed can't do it all. They've only got one or two monetary policy tools in the box. So this isn't going to just end anytime soon. It's hard to watch the value of our investments go down, but that's what makes investing rewarding for those who are patient and can just hold on, not worry, and continue to look for opportunities in the market. Thank you for joining me today. If you'd like to read any of my articles about the markets, equities, bonds, fixed income, you name it, please go to themodesteconomist.com.